Have you tried to withdraw your own money lately? I am talking about a significant amount, maybe $3,000 or $4,000 to buy a used car or pay a contractor. If you have likely felt the chill in the room. The teller's smile fades, the questions start. What is this for? Do you have proof of the purchase? We need a manager's approval. Suddenly, you aren't a customer accessing your property. You are a suspect in an interrogation. What if I told you that the glitch at the ATM, the lower daily withdrawal limit, and the temporary branch closure in your neighborhood aren't inconveniences? What if they are the bars of a digital prison being quietly welded around you while you sleep? The official narrative is simple. Cash is dirty. Digital is convenient. We are protecting you from fraud. But that is a lie. The war on cash isn't about fighting crime. It is about fighting you. It is about stripping you of the only financial privacy you have left. Look at your grocery bill. Look at your rent. The system is cracking under the weight of debt, and the architects of this economy know a collapse is coming. They need a way to lock the doors before the building catches fire. And cash? Cash is the fire exit, and they are bricking it up. Before we expose the mechanism they are using to trap your life savings, I want to know who is awake out there. Where are you watching from? And have you noticed your local bank branches disappearing? Let me know in the comments. And if you want the unfiltered truth that the mainstream financial media is too scared to print, hit that subscribe button right now. Let's follow the money into the dark. To understand the trap being laid for you today, we have to look at the last time the government decided your assets were actually their assets. The year was 1933. The United States was in the throes of the Great Depression. The banking system was collapsing because people, rational, terrified people, were rushing to banks to exchange their paper dollars for gold coins. They wanted hard assets. They wanted out of the system. So what did President Franklin D. Roosevelt do? He didn't fix the banks. He criminalized the exit. On April 5, 1933, Executive Order 6102 was signed. It effectively made it illegal for U.S. citizens to own monetary gold. You were forced, under threat of 10 years in prison, to turn in your gold to the Federal Reserve in exchange for paper money. Once the government had all the gold, they immediately devalued the paper money you just received. They stole your wealth by locking you into a currency they could manipulate. Sound familiar? Fast forward to today. The asset isn't gold anymore, it's physical cash. The paper bill in your wallet is the last bastion of anonymous, private value transfer that doesn't require a battery, an internet connection, or a bank's permission. Just like gold in 1933, cash represents the ability to exit the banking system. And just like 1933, the authorities are realizing that they cannot control the economy if you have an exit. Look at Nigeria in 2023. The government forced a demonetization policy, redesigning currency notes and limiting withdrawals to force the population into their CBDC, the e-naira. People were left starving, unable to buy food because the digital infrastructure failed. The government didn't care about the hunger. They cared about the compliance. Sound familiar? Look at Canada in 2022. During the trucker protests, the government utilized the Emergencies Act. They didn't send in tanks first. They sent in the banks. They froze the bank accounts of protesters and anyone who donated to them. No trial, no judge, just a switch flipped at a server farm
and suddenly citizens were locked out of the economy. If those protesters had been operating entirely in cash, the government would have been powerless to stop them financially. The digital ledger was the weapon. Sound familiar? The pattern is undeniable. In 1933, they closed the banks for a bank holiday to stop you from getting gold. Today, they close branches for restructuring and lower ATM limits for security. In the UK alone, over 5,000 bank branches have shut down since 2015. In Australia, the Big Four banks are removing ATMs at a record pace, leaving entire rural towns with zero access to physical money. They tell you it's because consumer habits are changing. They say everyone loves tapping their phone. That is the illusion. The reality is a forced migration. They are making it inconvenient, expensive, and suspicious to use cash. They are training you, like a lab rat, to press the digital lever because the cash lever no longer dispenses pellets. This isn't just about tracking your taxes. That's the small game. The big game is about systemic solvency. The global debt bubble is hundreds of trillions of dollars. The banks are leveraged to the hilt. If even 5% of the population decided to pull their cash out tomorrow, the entire global banking system would collapse by lunch. The banks know this. The central banks know this. They are terrified of a bank run. But in the digital age, a bank run doesn't look like a line around the block. It happens in seconds on a smartphone. The Silicon Valley Bank collapse proved that. Money moves at the speed of light. So how do they stop a digital bank run? They ensure there is nowhere for the money to go. If cash is eliminated, you can't withdraw. You can only transfer your money from one failing bank to another failing bank. You are trapped in the casino and the doors are locked. But to truly understand why they need to lock you in right now, we have to look at the mechanism that keeps the entire illusion alive. It's a mechanism so devious, so contrary to the laws of nature, that it requires the total death of cash to function.
You might think the war on cash is just about corporate greed, banks wanting to save money on security guards and armored trucks. Or maybe you think it's just the government wanting to tax every garage sale and lemonade stand. While those are true, they are merely side benefits. The real driver is something far more terrifying. It involves a concept that violates thousands of years of economic history. It is the only tool central banks have left to fight the next recession, but it has a fatal flaw. The flaw is you. Specifically, your ability to hold a $20 bill. The mechanism they are desperate to implement is called negative interest rates. In a normal world, you lend money to the bank, known as a deposit, and they pay you interest. In the new normal they are preparing, you deposit money and the bank charges you interest for holding it. Your savings shrink every day they sit in the account. It is a tax on saving money. It is designed to force you to spend, to speculate, to keep the velocity of money moving, to prop up the zombie economy. But here's the twist. As long as cash exists, negative interest rates are impossible to enforce. Why? Because if the bank charges you -3% to hold your money, you will simply go to the ATM, pull it all out, and put it in a safe. You avoid the tax. You break their policy. So, to enable this new era of parasitic finance, the physical exit option must be destroyed. Who is orchestrating this? It's not just your local politician. It comes from the central bank of central banks in Switzerland. They have outlined a blueprint for a unified financial control grid. It's a project that combines tokenized deposits, wholesale CBDCs, and programmable contracts into one inescapable net. You are being herded into a pen where your money is no longer your property. It is a programmable coupon that they can expire, limit, or tax at will. And the receipt for this transaction? The receipt is wilder than you think. You won't believe the name of the project that is currently being tested to make this global nightmare a reality. Let's rip the mask off. The project I mentioned, it's called the Unified Ledger. This is the Endgame concept pushed by the Bank for International Settlements. It envisions a world where all central bank money, commercial bank money, and different assets live on the same programmable platform. But before we get to that dystopia, we need to understand the mechanics of the trap you are currently standing in. We need to talk about the bail-in regime. Most people know what a bailout is. The government uses taxpayer money to save a failing bank. It's unpopular, it causes riots, and it's politically expensive. So after the 2008 financial crisis, the G20 nations quietly changed the rules. They replaced bailouts with bail-ins. Under a bail-in scenario, when a bank fails, the government doesn't come to the rescue. Instead, the bank is authorized to recapitalize itself by confiscating the funds of its depositors. You need to understand the legal reality of your bank account. When you deposit cash at the teller, you are not storing your money. You are making an unsecured loan to the bank. You are a creditor. The money is legally theirs, you just have an IOU. In a bankruptcy, unsecured creditors are last in line. In 2013, we saw the test run of this in Cyprus. When their banking sector collapsed, depositors with over 100,000 euros saw 47.5% of their savings simply vanish overnight. It wasn't stolen. It was converted into worthless bank equity. Imagine waking up tomorrow. You check your app. You had $50,000 saved for a down payment. Now you have $25,000 and some shares in a bank that is currently on fire. Now apply the war on cash to this mechanic. If you smell smoke at your bank today, you can run to the ATM. You can wire money out. But what happens when ATM limits are reduced to $200 a day? What happens when branches are closed and you can't demand a cashier's check? By shrinking ATM limits, they are reducing the run risk. They are making it physically impossible for the herd to escape the slaughterhouse. They are ensuring that when the bail-in happens, your liquidity is trapped on their balance sheet to fill the hole their gambling created. This brings us to the second mechanism, central bank digital currencies, or CBDCs. CBDCs are not just digital dollars. They are fundamentally different. A digital dollar in your bank account today is a liability of a private bank. A CBDC is a direct liability of the central bank. But the key difference is programmability. Cash is a bearer instrument. It is peer-to-peer. It has no memory. It has no bias. A $20 bill works the same for a saint as it does for a sinner. A CBDC is surveillance money. It allows the issuer to dictate where you spend it through geo-fencing, what you spend it on through carbon allowances, and when you spend it through expiration dates. Let's look at the numbers because they don't lie. According to the Atlantic Council, 130 countries representing 98% of global GDP are currently exploring a CBDC. This isn't a conspiracy theory. It is a global rollout. In the United States, under the Bank Secrecy Act, the reporting threshold for cash transactions is $10,000. But the illusion is that they only watch the big moves. In reality, they are pushing to lower visibility to $600. Inflation in the U.S. hit a 40-year high of 9.1% in June 2022. This is the silent robbery of cash.
But with CBDCs, they don't need inflation to devalue your money. They can simply apply a negative interest rate. The FDIC typically insures up to $250,000, but the FDIC Insurance Fund only holds about 1.27% of the ratio to insured deposits.
If a systemic collapse happens, the insurance is a mathematical impossibility. It is a sticker on the window, not a shield. This is parasitic finance at its peak. The system consumes the host. Let's look at the zero lower bound problem again. Central banks want to stimulate the economy. Usually, they cut interest rates, but rates have been near zero for a decade. They can't go lower because of cash. If they force a transition to a cashless CBDC grid, they can press a button and declare a negative 5% interest rate. If you have $100,000 in your account on January 1st, you will have $95,000 on December 31st. What does this do? It forces you to spend. It forces you to buy stocks, buy real estate, buy anything to stop the bleeding. It creates an artificial boom based on the destruction of savings. It is an engineered collapse of the middle class to protect the asset prices of the elite. And the ATM limit? That's the gatekeeper. If the limit is $3,000 a day, you can drain your account in a month. If the limit is $300 a day, it takes a year. If the limit is zero because they removed the machine, you are stuck. This brings us to the concept of moral hazard. Because the banks know you cannot escape, they can take infinite risks. They can gamble with your deposits on derivatives, knowing that if they win, they keep the profit. If they lose, they bail in your deposits. The shrinking ATM limit is the physical manifestation of your loss of freedom. Every branch that closes is a severed artery of liberty. Consider the consultation rooms appearing in banks. Have you noticed? They are removing teller lines and replacing them with desks. They want you to sit down. They want you to use an app. They want to advise you. This is psychological conditioning. They are training you to ask for permission to move your own value. When you go to an ATM and it says daily limit exceeded, that is not a machine error. That is the system telling you, you do not own this. The greed here is immeasurable, but it is framed as safety. They say criminals use cash. Let's be real. The biggest money laundering operations in history, Danske Bank, HSBC, Wachovia, were done through digital ledgers, approved by executives in suits, not by guys with duffel bags of cash. The cash is for criminals narrative is a gaslight. Cash is for privacy. Cash is for autonomy. The infrastructure they are building, the biometric scanners, the digital IDs, the unified ledgers, is not being built to serve you. It is being built to harvest you. When cash is gone, every transaction you make is data. Your coffee purchase, your medical bill, your donation to a political rival. It creates a perfect profile. And in a cancel culture world, that profile determines your access to society. Remember the Canadian truckers? That was the prototype. Financial deplatforming is the modern Gulag. And without cash, there is no tunnel out of the Gulag. We are standing on the precipice of a totalitarian financial epic. The modern system is faster, more global, and more fragile than anything FDR faced in 1933. The next collapse won't happen over months. It will happen over a weekend. And when the markets open on Monday, the rules will have changed. The shrinking ATM limits are the canary in the coal mine. They are signaling that the liquidity crisis is already here, hidden behind the curtain of fractional reserve banking. If you choose to stay in denial, believing that it can't happen here, or that my bank is too big to fail, you are playing Russian roulette with a fully loaded gun. You are trusting institutions built on borrowed time and moral hazard. You are trusting arsonists to put out the fire. The window to act is closing. Preserving a portion of your wealth outside the digital system, in physical cash, precious metals, or self-custodied assets, is no longer just prepping. It is a basic act of survival. Do not let them gaslight you into thinking convenience is worth your freedom. Convenience is the bait. Control is the hook. I want you to think about this the next time you tap your card. Who really owns that transaction? You or the intermediary who can turn it off? Share this video with someone who thinks cash is obsolete. Wake them up before the ATM screen goes dark for good. And if you refuse to be a passive victim in this financial war, subscribe to this channel. We are building a community of the awake, the skeptical, and the prepared. Are we wiser now than we were in 1933, or are we walking the same path in better suits? I'll see you on the other side.